Manish, we spoke to you about this last week. I mean, just to follow up, this idea that we're testing the rally we saw yesterday, where do you see the markets going from here? Do we have lower to go when it comes to the S&P?
So I think the upside is limited from here. My price target is 4,500, which seemed very close just a few weeks ago, but it's some distance away. But I would say in the short term, I think the risks are still skewed to the downside. So just talking about what happened yesterday, I think, there were certain elements which were bullish especially from the press conference, as you just mentioned, that the 75 basis point hike is off the table. That was, that at least put a cap in some sense on how fast they can hike. And he also said that, he reiterated that the claim that the economy was very well positioned to handle the hikes, the corporate and consumer balance sheets were strong and so forth. So those were sort of the bullish elements which maybe led to this pop, including the fact that positioning has been very bearish. You can look at sort of, institutional investor surveys, you can look at the retail surveys. All of them show a lot of bearishness. So that was a bit of a pop from there. But if you dig into that a little bit more, there were elements of caution, right? So first of all, he clearly said he would not deviate from the path, even if he gets some, 1 or 2 months of soft data. He really needs convincing evidence that inflation will come down. And the second thing I would say is that the strong corporate balance sheet argument is actually a double-edged sword. Because right now, because companies do have a lot of cash, they're not getting affected by these higher rates. So that just means that the Fed actually has to push harder, for them to really, change any behavior. So that's the other side of things. And of course, the drumbeat of negative news just continues. China PMIs were pretty awful. Over the weekend, we got this hike from the BOJ, which was, and I think the key thing there is the fact that they're forecasting almost a recession. Potential recession if things continue as they are. So a lot of negative headlines there. Some clarity from the Fed, but still risk to the downside.
So the question I keep coming back to, as we see these incredible moves on a daily, even intraday basis, Manish, is how should investors be positioned here? I mean, the moves are so dramatic. Get out of equities altogether, park your money just into cash for now. Bonds, which are going down almost or had been almost simultaneously with equities. I mean, what do you do?
No, it's a tough call. And, there is almost, nowhere to hide. And, even if you look back at the 70s and 80s, the total returns for equities were not bad. But, they were very close to what cash delivered for you. So ultimately, I think cash is probably the safest place right now. I mean, in terms of sectors, we do like, although there has been a lot of pain, in financials recently, but I think financials are well positioned, we think, for a high rate and potentially sort of a not too flat of a yield curve. And as long as we avoid the outright recession, they should do well. We still like the healthcare sector, although it has been a tough situation this month. Then within the technology sector, I think obviously there has been a lot of re-rating, but if you want to find a place to hide, I think we like to be selective. So I think we are still okay with some of the large cap tech stocks, especially how much re-rating has happened there. And also we like the cloud stocks. I think that story has legs. So from a medium-term perspective, the decrease in valuations there is a good entry point.